Hey guys, have you heard the saying, sometimes when you try to pick a bottom, all you end up with is stinky fingers? Well, how does that colorful Wall Street adage resonate with your trading? And well, today, guess what? We have the pleasure of meeting the man who coined that term. and anyway, welcome to Trading Truths, where Mike Lamoth, co-founder of Mara Wealth, and me, Dennis Wilborn, founder of AutoPilot Trading, shine a light on trading truths, trading myths, and offer actionable insight. So again, thank you for joining us. Let us know where you're dialing in from. And so this is another episode of Trading Truths. And I'd introduce Mike. And today we have a very special guest who will help us debunk some of the biggest myths in the trading world. Mike, would you like to go ahead and do the honors of introducing our guest?
Yes, absolutely. So it's my pleasure to introduce Andrew Rocco. Andrew grew up with parents who have a combined 80 years on Wall Street, both working as traders at Merrill Lynch. This early exposure to the financial markets gave him a unique and insightful perspective on trading. His career has taken him from MarketSmith and IBD to now over being at Zacks. Andrew's hands-on experience and deep understanding of market dynamics make him the perfect person to help us tackle today's topic. So, Andrew, welcome to the show.
Thanks so much for the great introduction, and great to be with you, Mike and Dennis.
Thank you, man. I kind of threw out a title on today's show of, Trading Truths, technical analysis is for suckers. Now, is that a myth? Is that the truth? And I'll just ask right out of the box. One, how did your early exposure to the market shape your understanding of technical analysis, beyond the short-term trading? And I'll throw in a little bit of extra there. Did your mom and dad use technical analysis in what they did when they traded for Merrill?
Sure. Yeah. So I think when you think of technical analysis, or when most newer traders think about technical analysis, they immediately think that you're staring at like a 1-minute chart, you're watching every tick, and they kind of get lost in the sauce in terms of that view. And I'm a big believer in technical analysis, but again, there's a ton of myths when it comes to the practice of technical analysis. I believe that when you expand your time frame, the best traders that I know, and it took me so long to understand this because everyone wants to have 4 or 5 screens up with a very short-term chart. It looks really cool, but unfortunately, we're looking to make money and not look cool. So what I found is that when I expanded my time frame, I'll look at generally monthly and weekly charts the most. I even go up to annual and quarterly charts. And I think even if you're trading the shorter time frames, it pays dividends to look at these longer time frames because it's going to give you the general trend of what's going on, and it's going to block out the day-to-day noise. Remember, the shorter the time frame that you're looking at, the more noisy it's going to be. So I tell people, don't be looking at a 1-minute chart and then trying to swing trade a stock. You're going to get shaken out. It's kind of like a volume dial on your emotions. So yes, my parents, they were kind of a little bit more niche in their field, but they definitely utilized those dynamics. I had other family members on Wall Street as well who introduced me to technicals. But again, as we talked about before the show, it took me years to learn that it's not about really the shorter term stuff. I think if most traders expanded out their time frame, it would save them years of headache and trial and error, kind of what I went through early on.
Just a follow-on question to that, Andrew, is you mentioned you go all the way to annual length charts, monthly or quarterlies, monthlies, weeklies. What do you believe, or what has been your experience for what the best time frame chart to utilize for doing swing trades? The trades are going to last 2 weeks to 3, 4, 6 months maybe.
Yeah, I would say probably 75% of the trades that I take are off of a monthly or a weekly chart. I do look at the daily. The daily can give you some insight, especially if it's like coiled really tightly. I like to buy stocks that are coming out of a nice tight consolidation, but I'm always going to be deferring to the weekly and the monthly. Those are going to hold the best weight for me, the most weight. Now, again, every trader is different. I'm not someone who's going to come on here and say that my way is the best. You should only look at those particular charts. But I think if most traders started from there, I see a lot of newer traders. I've worked with a ton of newer traders over the years. And what I found is that most of them are focused on too short of a time frame. We could get into position sizing and things like that, but their position size way too large. So if your position size too large, and then you're looking at a 1 minute chart with a 50-second moving average, you're going to get it's like riding a roller coaster after drinking. You're going to be throwing up your position everywhere. So it's not going to be good.
Okay.
So why do you think that the newer people tend to focus on that? Like there's the cool element that you mentioned. Are there other things that people are trying to do? Like, I've got to be dialed into this 1 minute chart or this.
Yeah, I think it's kind of like a rush. I mean, it's the same reason that people pull the lever in Vegas. You see that they want the bright flashing lights. You kind of get that feeling in your stomach, especially if you have big money for you, regardless of who you are. If it's a big percent of your money in a stock, you're going to get that rush. And when you're right, it feels good. And unfortunately, a lot of the traders that I've run into, these newer traders, they've hit early success sometimes. And that almost is a detriment because then they don't learn about risk management. And obviously that risk of ruin, it's just a matter of time. I mean, trading is really about simple mathematics is what I've found. One of the best quotes that really changed my trading, it was in a Tony Robbins book. I don't even think I've read the book. I just read the Paul Tudor Jones section because I'm a big fan of his, but he talks about the 5-to-1 reward to risk ratio. And he says, you'd have to be a complete idiot to not make money over time if you implement that 5-to-1 reward to risk. Because if you're right just 20% of the time with that ratio, you're going to break even. If you're right 30% of the time, you'll make some good money. 40% of the time, you're going to make a really good living. So I think that traders, they're so hyper focused on what's the best stock, what's the hot stock, that they don't pay attention to the money management aspect of it, really kind of identifying what they're looking for technically. It's just kind of like, oh, this looks good, maybe I'll buy it. It's no. Did it give you a signal? It should be binary. It either gave me a signal or it didn't. So I think if traders really modeled out a little bit more and studied themselves and not just try to get hot stock tips from other traders, I think that would benefit them, of course, in the long term a bit more.
Do you think that people define their signals?
I would say probably 9 out of 10 don't. And then of the people who do, of that 10% who do, a lot of them don't actually follow it because it's one thing to write it out and then another thing to follow it. So I think very, very few traders, again, they might look at technicals or they might look at fundamentals and say, oh, this looks good, but they don't have a definite setup. I have. And for example, in my trading, I have exact alerts set kind of to the penny. Needs to close over this point at a certain time. It needs to hold over this point for a certain time. It's either I'm taking the trade or I'm not, but there's no guesswork involved.
That's really absolutely fantastic, Andrew. And it's interesting in, you and some of the other people that we've had on the show, and Mike and I both, agree and follow that kind of a philosophy. I mean, I'm very succinct in I have very simple rules. I have 3 setups with a couple of triggers. That's it. And I just wait for those. I'm watching a very reduced number of stocks and leveraged ETFs. Again, very controlled, very limited, because some of the ETFs that we watch with autopilot trading is I've studied them in the past, and I know, like TQQQ is an example. TQQQ, somewhere between 4 to 6 times per year, will go on a run of 20 to 25%. If I'm working with that and capture even half of each one of those moves, then I'm compounding at almost 100% per year. And which is rich. And then the rest of the time, I'm taking care of other things like enjoying my family, my grandkids, and all that type of stuff. And I like that freedom. It's almost would be a fair statement to say that if a trader will develop rules and then that for a winning system with an edge, and then follow those rules succinctly, that actually equates to freedom.
Of course, yeah, and one thing that I think once people have studied investing and trading a little bit, they start to realize that, okay, I need to find this system with an edge. But as I mentioned, it's one thing to say I need an edge. It's one thing to study and understand it. It's another thing to implement it, because a lot of traders, they don't understand it's a series of trades. So you could be wrong 4 out of 5 trades. I know this year, just a couple of trades have paid for all my losses, but I've taken, in some stocks, I took 2 or 3 losses in a row before, hitting the big one. So I think that's another mistake. They think of it as one trade. Oh, this trade is going to get me to the promised land. It's no, this system applied over a series of trades, kind of like a casino. You want to be the casino. They have that slight edge. It's played out over a bunch of hands, and over time, that works in their favor. And I like the point that you made about freedom and just kind of stepping back. You're not looking at that 1-minute chart. You're trying to catch the big swings. If you're wrong, you're going to cut out, where you're cutting out, and then you're going to run your winners. But again, it's so hard to do that in practice versus just talking about it. But once you start to understand the simple math, you don't have to be a Jim Simons to make money or to be profitable in the stock market. Obviously, it'd be helpful if you had his kind of what his math expertise was, but you really just have to understand the simple math. That's why I think anyone with the right emotional and psychological backdrop can really figure out this game.
Awesome. Do you think that people get confused between the signal part and being the casino part? Because if a casino has a slight edge, and they're trying to turn that edge over and over very quickly, do you think that people take that and think, oh, I heard that soundbite, that means that I need to go over to this 1-minute chart and try to, trade 100 trades a day?
Point. Yeah, that's a great point, Michael. So I would say it wasn't the best example. Let me give you a better example. I would say, for me, and I can only speak to what's worked for me. Once again, there's a million ways to skin the cat, but I've been doing this for a while. And what I found is, think of a baseball batter. You want to be a Barry Bonds. You don't want to be Ichiro Suzuki. So you want to hit for that slugging percentage. You want to have some home runs, some doubles. You want to hit for power. You still want to work on the batting average as much as possible, but you don't want to be a base hitter, because there will be times when the market is chopping back and forth, and you're going to make, when the market does finally trend, as Dennis said, there's 3 to 4 times a year when this market's really going to take off. This year, it seems like it's been the whole year, but it's not always going to be, roses and jet skis here. So, when the market's choppy, you want to defend your capital. When it trends, you want to ride that out. But again, I would say probably a better example, that was a great point, would be kind of slugging percentage as a baseball batter.
Yeah, that's fantastic. And we're in the middle of baseball season, so that's
Yeah.
perfect.
Yeah, that's a fantastic, and especially since I grew up in California and just watched Barry Bonds play. Was he? Yeah, he was. Yeah,
I have
but-
the Marlins to watch. It's not too fun.
okay.
About as fun as the
They're
Mets.
pretty weak, but the seats are super cheap. If that's the one good thing
Without a
about it.
doubt. So yeah, Andrew, before we get off the aspect of technical analysis, what are some of the just basic common misconceptions that traders have about the limitations of technical analysis? And then you said you've been trading a long time. Second on that is, how long is a long time to be trading? That you've been trading.
I traded my first stock at 13. I'm 34. Obviously, I wasn't hardcore at 13, but I've been following it as long as I could be following it. And obviously really got serious kind of in my 20s. And yeah, and I got consistently profitable probably in my mid 20s, I would say. So yeah, I've been doing it for some time now. And again, a lot of these, I can tell a lot of our listeners what they should do. A lot of this, unfortunately, will have to be learned in real time by losing money. But if I can even just save you a couple of years, it's worth listening to a podcast like this, because there's a lot of information that can be confusing out there. So I think it's good to listen to people who've been at it for a while.
Absolutely. And one of the things when we were speaking before the show was the economy or the macro being the main drivers behind stock market moves. Can you speak to that a little bit?
Yeah. So this is something that if you're on social media, you'll see, a lot of people will construe the economy with the market. And of course, there are some links to it. But if they're, let's say, I'm not going to get political, but let's just say they're a Biden voter or they're a Trump voter, they're going to say, if XYZ gets in, the market's going to crash. If my guy doesn't get in, the market's going to crash. Even the candidates both say that. And really what the market is, and I have my political views, I'm sure everyone does, but the market is driven by liquidity from the Federal Reserve, earnings moving forward. And I think a lot of the political stuff, a lot of the macro stuff, there's too much weight put on it. And I think there should be some weight put on it. But another thing that a lot of investors get wrong is they don't realize that the market is forward looking. So the market tends to bottom when the news is the worst. So for example, late 2022, I think it was October, when the market bottomed, is the same day we got that inflation reading where inflation hit 40-year highs. Right. Everyone was freaking out. I think the market opened up down 3%, and then we got this bullish reversal. So I like to really hone in on price action versus news. We got horrible news, and the market finished up on massive volume, and the rest was history from there. Same thing with the COVID correction. I remember, I think it was Ackman on TV. He was crying. The market, they said they're going to have to shut down the hotels, and that exact day is when the market kind of reversed and moved higher. Also, a lot of these economic numbers, they're stale and they're not looking forward. So what you want to pay attention to is where the liquidity is going in the market. We don't care about sounding smart. We care about making money, and the price action. That's why I love technicals. There's no magic or voodoo, but it tells us where the liquidity is going. We're trying to make money. Let's follow that liquidity.
Yeah, without a doubt. So go ahead, Mike.
Yeah, no, I was going to just say that to me, price action represents truth. Unfiltered, and it's just the driven by people's actual actions.
Yeah, and I agree with that completely. There's one chart that's in one of Mr. O'Neill's books that is Tennessee coal and it was from 1889, and it's a weekly chart. And oh my goodness, you could take that and plaster it. There's such a learning thing there, but you could take it and just compare it to NVIDIA, compare it to Tesla, whatever. And guess what? The charts reflect the personality of the people who are trading that entity. I mean, it tells you all you need to know about their level of greed, their level of fear, the pockets of where the buyers are hanging out, where the sellers are hanging out. And so, truly, price is king. But that's where I come from, and that's why a long time ago I fell in love with technical analysis, and I actually hire IBD to do my fundamentals. I trust them to do the fundamentals because I don't like doing fundamentals. And then I can just do my thing, which is the technical analysis part, and do okay.
I think you can combine the two and get even a further edge. But what I want to tell people is, without the technicals, if the fundamentals are great and the technicals aren't there, I will never trade it. And the technicals are going to get you to those fundamentally strong stocks. So it's funny you mentioned coal. I mean, in 2016, I believe, when it was Hillary versus Trump, she was saying that I'm going to do away with coal. Everyone was kind of down on the coal stocks. And then they had a tremendous run, which I still don't hear people talk about. I mean, those things like 10 bagged. And obviously, you don't have to get into the bottom. But if you were following the technicals, they would have gotten you into the chart. So what I look for is kind of the trifecta of liquidity. I like to trade liquid names. I find that they're more predictable. I want to see strong fundamentals, especially forward growth. As I said, stocks are forward looking, and then of course the technicals. So I'm like you. I do trade a lot of the index ETFs. I trade them with options instead of the leverage ones for the most part. But as I said, there's a bunch of different ways to skin the cat. But I think you want to be in the more active names, the NVIDIAs, SMCIs of the world, and that's where the action is going to be, because that's where the institutions are. That's where the RS is, etc.
Yeah. And just for clarification, I wasn't saying that fundamentals weren't important. I just thought I don't personally like to do fundamentals. So I contract with IBD and I trust their fundamental rating system. And so anyway.
Yeah, exactly.
Yeah, because fundamentals are crucial. I mean, if the fundamentals suck, I mean, there's no reason, I just kind of go, eh. But at the same time, I'm watching those technicals, and have they been on, I look for stocks that have been on past great list from IBD. And then I focus on basically just 8 ETFs, 3 indexes, and then 5 sectors that move a lot. Things like the semis, the biotechs, and all that kind of stuff. And they give you a really heck of a nice return.
Yeah, and one thing I would also mention is to think about catalysts in individual stocks. So one of my better trades earlier this year was Coinbase, and what I saw in that is it had strong fundamentals, it had technicals, had the liquidity, and then it had the backdrop of the Bitcoin ETF, which they're the custodial index on. We have the Bitcoin halving coming up, so there were several catalysts beyond that. So I'm looking for every edge. But again, the technicals are kind of my main focus, and then everything else on top of that is going to be kind of gravy from there.
Mike?
Well, when you're looking for some of these other elements that you're putting in, are these things that you've already, like you have a checklist of what it is that some of these other things are? No, or is it, what you happen to see that day that happens to pop up?
Yeah, so great question. So I'm scanning. I have a scan based on fundamentals and liquidity and industry groups. So I'm scanning through those lists every day. I'm looking for patterns that stand out to me. On any given day, there's going to be, in a bull market like we're in now, there might be a couple different names that stand out to me. Now, how do I choose between those names? Because obviously you can't allocate all your capital. You can't kiss all the different babies. So in that respect, that's where I'm going to use the fundamental side and the catalyst side to determine which stock I choose after they meet my technicals. So it's a way of further whittling down my watch list. And I do kind of think of it, if it's, I've used Coinbase in the past. I traded Robinhood. I don't use it, but I see a lot of my friends using it. So that's kind of where an art side of it comes into play. But I'm relying on those technicals to whittle down this vast database. And then once I get it drilled down on those technicals, I'm using catalysts and fundamentals to really select from there and really position into what I think are the strongest names.
Yeah, that's interesting.
So
well, like we all have slightly different ways, but are doing basically the same thing, which is building a giant funnel, whittling it down to just a handful of core ideas, and then waiting for the proper moment to jump in.
Yep, exactly. And I think having a routine and a process that might not be too overcomplicated, 2 or 3 different screens that you look at, but you just look at them every single week. Just so you get an idea of where the money is flowing. We just got this massive breakout in small cap, so that's something to look at. Obviously, semiconductors, as you said, Dennis, have been tremendous for years now, it seems. But yeah, you just want to be able to identify the subtle shifts in the market. And what you'll see is, today we have several of the Bitcoin names breaking out. You'll see the volume come into one industry group, and it's kind of flashing like, hey, look at me. It doesn't mean you just run out and chase these names, but that's the point of day in and day out. Just have a routine that you're going to follow. It's kind of like if you're on a diet. Let's say you're vastly overweight and you're trying to lose weight. If you just go cold turkey one day, you're less likely to follow. It's like, okay, I could have a dessert once a week or something like that. You're going to be more likely to follow the process. So I think start simple. As Da Vinci said, simplicity is the ultimate sophistication. Start simple. I think consistency is more important than having some extravagant, 10 different screens that you're running on any given day.
Yeah. So you mentioned, Andrew, you mentioned the aspect. Well, one, I love the analogies that you use and the things about Da Vinci and you can't kiss all the babies, because I use the same ones. No, but no, they're really awesome because they express so much. My question is, though, is just in a very simplified format. Okay, you found the stock, and it's all lined up. So what? And I recognize everybody needs to have their own triggers, but what are your current either setups or favorite setup and trigger that gets you into a stock? Are you putting in your orders before, after the market using conditional orders, or do you watch the market all day long? So a myriad of questions there.
Sure. Yeah. So I do sit at my computer all day long, but I'm working in between. I'm not just looking at my trading platform the entire day. I would say that the 2 things that I trade the most are monthly bull flags and weekly bull flags. It's very, very simple of a pattern, and specifically what I'm looking for is an inside bar or a doji bar. What a doji bar is when it closes in the middle of a bar and it shows indecision. So if it closes above that time frame, it's telling me that the trend is likely to continue upward. So essentially what I'm looking for is an uptrend, a nice bull flag in the monthly or the weekly chart. I look for a uniform pullback. I found that the first tag of a moving average is going to be a very high reward to risk, especially in the fundamentally strong liquid stocks. And I piece in. So I'll buy a smidge on weakness, 1/4 of a position on weakness. Okay. And then as it triggers over a doji inside candle or over the high of the last time period, is where
Right.
I'll add onto my position. So that's another thing is a lot of traders, they think you have to be all or none. What I found is pyramiding into the position. You could do it a myriad of different ways. I like to do that first quarter on weakness, and I'm adding as we come through and get the daily close or weekly close above my level.
Okay. And then what kind of either a hard stop and then a trailing stop and profit targets along the way? Where do you take your profits?
Yeah, so what I'm using, first off, I'm trading a lot of options personally. So I
Okay.
go about 3 months out on my options. I'm looking for high open interest and volume. I want to be where the open interest is, where the volume is. But you could trade these same patterns with
Sure.
common, and I do occasionally do a combination of common and calls as well. But for me, what I love about options is that if a stock gaps down 100%, if it does Enron in one day, I know what I will lose that day. I
Yeah.
cannot lose more. Whereas common, you can lose more. I mean, it's rare, and you can of course mitigate your risk. So that's one of the things. Also taking things into earnings. There's a lot of different things that you could do, and we could get into. But that's it. And then I use previous resistance levels because I'm buying pullbacks. Remember, I'm buying
Sure.
pullbacks that are curling up, if that makes sense. So there's previous resistance, and then beyond that, I'm using fib levels. And
Okay.
again, fibs, there's nothing magic about fibs. It's just a framework that I've found that the market reacts to more often than not, and it's something that I'm using. I'm not saying that it's the solving the world's problems or anything like that, because people, I see people on social media, if you say fibs, they're like, oh, what kind of wizardry is this? It's just a framework for me to pyramid out of my positions and manage them.
So yeah, I trade fibs also, and again something very similar, but but the people I coach, I don't get into the option side of it because that introduces a whole lot of variables that it's a little bit more challenging to manage, and so I just basically do the standard stocks and ETFs, but I personally trade. Okay, I trade the weekly options on leveraged ETFs.
Wow, that's
They
some nice leverage you're getting there.
and they are absolutely rich. You gotta check it out when we're done. TQQ and look at the weekly options on it. Great open interest and oh my gosh, just
Oh yeah, yeah. I love
okay.
the QQQ and the IWM, all of those guys. But yeah, I think what you're saying, I would probably not recommend someone trade options if they haven't been trading common for maybe like 5 years.
Yeah,
So
right
I
on.
traded common for a very long time because let me warn everyone, if you just jump right into options, that is the quickest way. I mean, it's quicker than burning money in a fire. You're going to lose money. So I need to preface with, yeah, trade common for 5 years. It's the same technique, and eventually move on to that. But I would definitely not jump right into the option game. So that's a good point.
Excellent. So let's see where we want to go from here. Mike?
How about valuations?
Yeah. So okay, I lived through the bubble of 2000. Okay, I traded through it, and also the one of 2007 into 2008. Um, why do you think the term bubble often carries a negative connotation, and how should traders really reframe their perspective about bubbles?
Yeah, so I think I don't know the reason, to be honest, that bubbles have such a bad connotation. I think that a lot of people have maybe watched The Big Short and they want to be that guy who calls the top. I think it might be ego driven, but
Mm,
everyone just says this is a bubble, this is a bubble, and it very may well be. But there's a great one of my favorite trading quotes is Soros. He says, "When I see a bubble forming, I rush in, adding fuel to the fire." So what bubble means to me is it means stock prices are moving up really, really fast, and often the end of a bubble, you're going to get those climax tops. You're going to get those crazy gap ups where it's just like, okay, the game, if you've watched technicals for a while, you're going to say, okay, the game is over. You know, if you've studied your historical charts, as you've mentioned. So I think it means that prices move up very fast, and then it's pretty obvious when they stop. So I'm one who gravitates towards them. Now, that does not mean I'm buying stuff that's extended, but I'm looking for the hottest stocks coming out of low risk entries. And then I'm looking to take advantage of that. And if it ends badly, or even if it ends that day that I purchased it, I have my downside protection in place. So yeah, I think kind of the reason is again, it's just people want to be the one who calls out that top. I think it gets a lot of hits on social media and on CNBC. If you go on CNBC with a bow tie and you say, you know, 2008's around the corner, you're probably going to get more views than someone who says, okay, I think the bull market's just going to continue or will consolidate, something like that. So
right on.
a variety of reasons.
Yeah, I think that makes a really good point about media in general. Right? Like, so yeah, you take a look at you mentioned the MSNBC, Fox, those like the headlines versus, you know, like what's actually going to be useful to trade.
Exactly. And I turned off the TV a long time ago. Now, if there's something going on, I'll have it on without the volume. I mean, if something huge is going on, maybe I'll turn the volume, but 99% of the time, I'll either have it off or I've been to work for and been to a bunch of different trading floors, institutional. It almost always, they have CNBC in some corner of the room without volume on. So I don't think there's any value to be gained. Even if the person on TV is giving out good information, it's not your process. So you have to be trading your own game. Trading is a game of us versus ourselves. So that would be the first thing. There's so many distractions, especially nowadays. You have 3 screens, you have your 1-minute chart, you have CNBC. So there's going to be the phone. Yeah. You got the phone that you're checking. So there's so much noise. If you can be the person to strip out that noise and just look at it, cool, calm, collected, try to be unbiased, have a heavy weighting towards price, I think that's going to be beneficial. Now, again, it might not be as entertaining, but you have to decide whether you want to be entertained or profitable. And being profitable is much better, in my opinion.
I agree.
Yeah, absolutely. How do you think people could go about getting to that place? Because it probably takes quite a bit of, well, from my own perspective, it takes quite a bit of confidence to get to that level where you're filtering out the noise. Part of the reason why I was consuming a lot of noise way back when was because I didn't have the confidence, and so I'm looking for somebody else to tell me all over the place. So how would you get to that place where you have that level of confidence?
Yeah, I think the way to do it is to find that process and monitor it, and maybe trade small or just even monitor the market. Look at a chart, look at your 4 or 5 best charts for the week, size them up, and then see what happens after and what would have happened if you just followed that process. And I think actually having a mentor, I think, could be super beneficial. I had one and it was very beneficial to me, but I don't think you should be in 4 or 5 discords and following all these different trading rooms, because one person might be trading breakouts, one person might be trading pullbacks. You want to kind of just find your niche and then build out from there. And I think, Dennis, what you said about just having a few different setups, trade the indexes. I think if you can learn the indexes, you can learn individual stocks better as well, and just keep making it very, very simple. Try and remove. I've heard Elon Musk when he's building some of the craziest rockets in the world, but he's like, can we just remove this? Can we get rid of that? So even in that framework, a lot of the smartest people, they're just trying to remove and first principles and get those results rather than overcomplicate things, make these big macro calls and things of that nature.
That's clarification and simplification is when I came onto that, it took me about 10 plus years to get to the point in my trading after blowing up a couple of accounts where I finally got to the place where, guys, I'm just being too complex with this. The engineer in me was going, oh, I can make it bigger, better, and all this type of crap. And the fact of the matter is there are just some basic principles of systems out there that are successful. And for whatever reason, that my humanness said, well, but I'm special. I need something extra. And that was a huge myth and lie that I was telling myself because I didn't. I just needed something that was going to work. And and guys, hold on because we are going to get back to asking Andrew about that question about picking the bottom, but not yet. We're going to get there. But Adam, Andrew, excuse me. What are some of the most persistent myths you encounter in the trading world? Just top five or which ones?
So I think, let me just think about this. I would say number one is that stock selection is the most important thing. I think that, as I mentioned before, people will study social media, they'll watch TV looking for this hot pick, but if they just took even a minute to study themselves, I bet 90% of traders don't do a post analysis, and I understand why, because it takes a lot of time. But at least once a year, I do an intensive. It's like a week-long thing where I go through my top trades. What you should do is your top 10 trades, your top 10 worst trades, your top 10 best, top 10 worst, and kind of dissect them, see what you did right, see what you did wrong, do your profit factor. What's really cool is you can plug all this information into ChatGPT. So it will save you a lot of time nowadays. You can leverage this new technology. But even if you're just doing it the old fashioned way through Excel, I think people don't study themselves enough, and it's just randomness. And it's John told me that XYZ is going to go up, let me buy it, and they're just kind of throwing spaghetti at the wall. So that would be the number one myth, is that finding hot stocks is more important than looking inward and looking at your own trading. And I would say another one would be too hyper focused on just trying to hit it out of the park and not paying attention to the simple math. I shoot for 3 to 5 R, which is 3 to 5 times what I'm risking. And I just know if I keep that ratio, it's going to work out over time. People get too caught up in their short-term results. So there's going to be some periods, even if you're the best investor. I mentioned Jim Simons before. He had a really, really rough patch, but eventually he came out of it. And for years, then he was earning, 60% a year. So if you're confident in your system, you have to be confident that you're going to go through. There's times where there's going to be a string of losers, and you should not put too much emphasis on one trade. Like if you feel like you won the Super Bowl, if your stock went up, or you lost the Super Bowl, you're not doing it right. You got to position sizing, as I said, is kind of a volume dial on your emotions and your psychology, and you're going to make those knee-jerk reactions if you're trading too large.
Yeah. And so, I like to call that, you need to pay attention to your body of work. It's not just one trade here, there, and all kind of stuff. You mentioned 3R or 5R. A lot of times there's a disconnect. People and folks and new traders out there don't make the connection that if you're hitting 3R, that if my math, I'm doing it in my head right now, but that math turns out to be is you only need to win. If you're doing 3R, you only need to win like what, 4 out of 10 trades, or is it even less than 4 out of 10 trades to be break even or slightly profitable?
Yeah. And again, people are too hyper focused on batting average and not slugging percent.
Mm.
Because, you know, even the best investors, I mean, Buffett was wrong on the airlines a couple of years ago, but then he made 10x that on Apple. So even the best guys, I mean, Soros is not right every time, but when they're right, they really hit it big, and when they're wrong, they cut out for a loss and move on. But I think ego gets in the way of taking those losses, and riding the winners isn't easy either. That's why some of those fibs and kind of selling along the way can help in some instances, with not just having, you know, I'll sell it when it goes up XYZ. It's having those levels in place to look at.
Yeah. And also having an understanding that every time you sell, you're taking risk off the table.
Mhm.
And even so, anyway, where are we at, Mike?
Uh,
Do you like
how
that
was
one?
your, yeah. How has your understanding of black swan events influenced your risk management strategies?
Yeah, so black swan events, I found that they happen every 4 years. Um, People say black swan like it's a once in a century thing, but think about it. We just had COVID. We've had the crazy rally after COVID. So you what that means is you just need to have your risk in place, and you need to be ready to react and not assume anything. As I mentioned, the inflation hit the 40-year highs. That was black swan. The market was getting crushed. I mean, the NASDAQ, people forget how painful 2022 was. The NASDAQ was just getting crushed. So you really need to know the environment that you're in. Actually, I want to touch on the valuation part that I mentioned earlier. So I'm not someone who's just saying, oh, valuations are crap, throw them out the window. But as a general rule, in bull markets, high valuation stocks will be rewarded. Even something with a P of 50, if they have that high growth, you know, the relative strength, the strong price action, they're going to get rewarded in a bull market. And in a bear market, they're going to get hammered. I mean, 2022, Nvidia was getting hammered the entire time, and then we went into a bull market, and it's the leader. So you have to have a way to look at the market, whether you're using the follow through day, the 200-day moving average, up volume, down volume, whatever you're using, you have to have some way to identify what type of market that you're in.
All right. So, Andrew, one of the questions I have, we always like to ask our guests is, you know, what do you specifically do to maintain a healthy work-life balance as a trader? Because I know for myself, speaking for myself, is it took me a while to get to the place where to learn how to click the switch to turn it off and go do other actually more important things. So how do you maintain a balance?
Yeah, so I play basketball Tuesdays, Thursdays, Saturdays, and then I'm going to the gym any day that I'm not playing basketball. So I find that physical actually helps my mind. And every day before the market opens, I walk outside. I'm lucky enough to be remote now, so I'm actually visiting my parents now, hang out with family. But yeah, I think you shouldn't be hyper focused on the market, but you should have, again, that routine. So keep it simple enough so that you can do it when it matters every single weekday, or Sunday night is even better if you do Sunday night and then during the week. But make it simple enough so that you can live your life outside of things. And also, if you're using a million different indicators and you're a million different screens, it's just going to be, you know, paralysis by analysis. So I would say just find a way to find the top stocks of the day. You want to be in the real strongest names, because that's the point of you can do really well by just buying the S&P 500. And I think a lot of people should just go in that direction, if I'm being honest. But if you want to do this actively and win, you have to be in the strongest names, or else there's no real point of doing it. The S&P, my brother, he's not involved in the market at all. He's just been throwing it in the S&P. Actually, in 08, he was throwing it in. He's doing wonderfully. but he's got his career in a different field. So if you do want to do it actively, hyper focus on those strong names. I mean, the strongest index over the last couple of years obviously been QQQ. Tech has been unbelievable. We're seeing small caps break out now, so that might turn into a focus. But those would be some pointers from that end.
I like that. Yeah, because because basically that balance is, it is, it's so critically important. So, Mike, what else? What other questions are out there for Andrew?
Yeah. So, you mentioned fitness, and you mentioned basketball too. I'm kind of curious. Are you playing on a team, or what do you do?
I have a WhatsApp chat with a bunch of guys, and it's just pickup, but it gets way too competitive. It's more competitive than if it were a league. It's really sad. We all have competitive problems apparently, but it's fun. We go out, have a beer after. But yeah, it's always the same group of guys, and if someone's out of town, we always have enough guys, and it's a really good free court in Miami that we play at. But yeah, it's a great way. You feel those endorphins come out, and I think even if you don't like it, just walk 7,000 or 8,000 steps. The iPhone will track your steps, but it really does help your mental framework, because if not, if you're just staring at a screen all day, you're just going to go crazy, I think. So.
Right on. Right on.
Well, let's dig into the mental benefits of the physical exercise, right? Because I think that we've all experienced this too, right? Well, if you're intensely exercising, it makes focusing on anything else kind of drift away, and you start to feel that that part of being in the zone, if that's the right way to phrase it. So if we're able to figure out that feeling of being in the zone, then it's something that we could look to mirror inside the trading day.
Exactly. And you know what's funny is I've found that when I'm a junkie, so I do like to look at the market, but when I have taken that 1 week vacation and come back is some of my best trading, because I'm just like, okay, let's get back to basics. What do we need to focus on to make money? And it just kind of reinvigorates you. So I think exercising is kind of that on a smaller scale. You're going to be less likely to make these knee-jerk decisions. You're going to be more calm. You're going to sleep better. That's for sure.
Right on.
Yesterday, I think I did like a 15-mile rollerblade. I did a chest workout, and I just slept, and I was ready to go in the morning. So all of this, if you're not in the right mindset, and I've seen guys, and obviously there's nothing you can do except trade less, but I've seen guys going through divorces, guys going through a tough time in their life, and that translates, unfortunately, to the trading world. So if you are going through a tough time, and we all do at some point, I would say just shrink your position sizing maybe until you start. If you're losing money, shrink your position sizing, get your bat on the ball, and then as you start to get back in the zone, then you can size up from there. So you always want to be looking at yourself. Sometimes the market's going to do what it's going to do, but often you'll find like I made some transition earlier this year where I decreased my position size, I widened my stop a little bit, and I increased my time frame, and it made a massive. I've had momentum ever since. It made a massive difference. Yep. So again, going back to that idea of studying yourself and see what you have to do to yourself to succeed in the market, because the market has no bias. It has nothing against you. It's going to do what it's going to do.
Absolutely.
Yeah, that's absolutely amazing. I'm thinking to myself, you've mentioned it several times. Study yourself. That is inclusive of both, not just your trading, but I think you're talking also about your mindset in this type of thing. And Well, okay, I'm going to say something here that people are going to go, nah, you're picking on people, but I'm not going to. That's okay. I'm old enough to be able to pick on whoever I want, and and the fact of the matter is that old adage of how you do anything is how you do everything is so true. And if you're sitting
100%.
there and you're out of shape and you couldn't walk up a flight of stairs without getting all winded and huffy and puffy and all that kind of stuff, okay, something is missing in your life that will translate to your trading in a negative way, not a positive way. You may be able to, and at least again, in my humble opinion, that's what I think. But I think, here, three of us, all three work out, we stay physically fit, and we've actually made it as part of yeah, there's Mike's pull-up
Yeah.
bar in the back.
That's
And
nice. I need one of those.
and so, you totally distracted me, Mike, dadgummit. No.
Sorry.
We stay we stay fit, and the fitness is part of our routine for trading. It's connected. And so I encourage folks to look at yourself, but also start the new habits. And Mike and I have talked about this in the past, is that a lot of times people, they want to, but wanting to isn't taking the action to do. Everyone can become a master trader. However, it takes sacrifice. It takes, sometimes getting out of your own way and getting the ego out of the way. And so, okay, Andrew,
Well said.
the question is, why did you write that about picking your bottom?
Well, in all fairness, it's a quote that my mother passed down to me, and it was a warning shot to not pick bottoms in the market because she's seen she was around, on Black Monday. She was on the trading floor. She was there in 08. She's been through so many. I mean, she was there before when they were shooting their trades through those tubes. So
Yeah.
she has seen it
Wow.
all. And yeah, I mean, that's really how you get hurt. I mean, you look at 87 when it crashed through the 200-day moving average. If you didn't heed that warning, it got pretty bad. I mean, even as I said, NVIDIA, it's easy to look back now and say, oh, it was so obvious. But in 2022, that wasn't so pretty. So you need to be able to be flexible and change gears. And that goes back to the ego part of things. If your setup's not there, if it breaks down, you have to be able to take that loss. On the same token, if it sets back up again, I think that's one of my bigger strengths as a trader. If I get stopped out of something, without hesitation, if it sets back up, I'm right back
Right
into
on.
it. So I think those are key things. And then it's all about trend. We're trying to catch a trend and ride it higher. Nothing more complicated than that. And what I like to say is if you're looking for the next stock to double, you know where the best place to look is the year before which stocks have doubled. That's where you're most likely to find it because that momentum continues. I mean, how many years has Bitcoin been running? NVIDIA, people were telling me NVIDIA topped like 8 years ago. These stocks, Apple is still going. These trends last longer than you think. You need to be able to navigate them. That's where our technical analysis comes into play. But these trends are multi-year things. So just watch those trends, pay attention to them. And then the key part from there is honing in, picking your spots.
Love it. So
Fantastic.
okay, well, Mike, go ahead. You want to basically you want to ask some more questions? I have one question. The question for Andrew is, Andrew, what questions would you have of Mike and I?
I would say, what is your biggest trading myth, do you think?
Go ahead, Mike.
I think the first one that I don't know if it's the biggest one, but certainly the first one that I fell prey to was that investing is as simple as you take money, you put it in, and you wait enough time, and more pops out the other side. So I started it back in 1999, and I didn't even know what a bubble was back then. But I went to my bank. I didn't even know where to start putting money to work in. I went there. They said, what you wanted these. They handed me some mutual funds. And so I thought, well, I've got the pros handling it for me, and I've got all this diversification in the mutual funds. And I was just starting college at that point, and so I wasn't planning to touch it until I would graduate. And so I had everything working for me. And so within a couple of months, I'm up 10%, and I'm thinking that I'm a genius for doing this. And then my studies get the best of me. Then I take a look at the account again in 2002, and I find my account down 20%. And I'm like, well, what in the heck happened? Right? Pros doing this for me, all this diversification, plenty of time. And I learned the hard way that it takes a little bit more than just those three things to make money in the market.
Yeah.
Dennis, how about you?
Oh gosh, mine are a couple of them. Is one, when I first started, you don't need no stinking stop losses, right? That was my the myth I believe, I thought, believed, because I thought I'm too brilliant. I'm too good of a technical analyst. I'll know when it's going to happen. The fact of the matter is hard stops. Well, lack of using hard stops caused me to blow up two accounts. So that's ugly. It's hard to explain that to your, I had to explain that to my wife. Oh, honey, that house we were going to buy. Well, the other one was I have to watch the market all day long, from early in the morning, from pre-market all the way through to the end. I had to be there for tick, 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 as if. And the thought pattern there was that I would have some influence over what the market was going to do. That was the belief.
Like wearing the rally cap for baseball?
Oh, yeah. And I turned that sucker around. And go, oh, no, baby, no.
There you go.
I'm sorry. I can't control myself sometimes. Mike doesn't know what to do with me, But yeah, exactly. And what broke me of that, I know we're going over a little bit, is after a trade went against me, and we were living in California, and I was so pissed off, I went downstairs and I had to get something out of one of the drawers in the kitchen, and I slammed that door on the drawer so hard that the front of the drawer popped off. And I'm going, oh crap. And so I called my son, who traded with me at the time. I said, Brandon, bring me some Elmer's glue. And so we glued that sucker on, and I said, back on, put the vise, the grips on it. And I said, please do not tell your mother. So anyway, those are my myths,
Yeah, no, that's a good lesson. One more point I'll make is you should never be negatively affected outside of trading. If you had a bad trading day, it shouldn't ruin your whole day. First of all, life is far too short for that.
Right on.
So yeah, don't base your life on your daily P&L, because even if you're the best trader in the world, you'll have down days. But second, it probably means you're trading far too large. So I'm glad you brought that up. That's something I learned, because a couple of years ago, I would get really down and out. I'm like, is this the life I want to live? And is this even proactive to my trading success?
Right.
So that made me think of that. Yeah.
So cool. So, well, Mike, I think we've come to the end of today's journey. Andrew, I want to say thank you so much, for coming on, for chatting with us, for sharing. And I know what you will have to, what you've had to say is valuable to the traders out there, because you have provided and broken through and enlightened on various myths and all that kind of stuff. So, Mike, you got anything to add?
Well, yes, Andrew, the many years in the making. I'm glad that we finally had a chance to sit and talk for a little while. For the people out there, how could they get a hold of you?
Yeah, so I'm on Twitter at Andrew Rocco 1. My name you'll see at the bottom of the screen there, 1. So I post various trade setups, memes, whatever you want. So yeah, you can find me there. I'm on Zacks.com. You can see I have a service that I run called the Tech Innovators Portfolio, where we're providing recommendations. It's kind of like learn while you earn. I'm giving you the reasoning behind the trade. I'm writing out a bull thesis, and then I'm walking you through the trade. So it has all my past trades. I think we have a $1 trial for a month or something like that. But anyway, you can find me on Zacks.com. I probably post the most on my X or Twitter feed at Andrew Rocco 1. Feel free to reach out to me on Twitter via DM or on my feed, and I'm happy to talk with anyone, answer any questions from there.
Cool. And we will put in the descriptions over on Spotify and the YouTube channel, how to reach out and contact Andrew. So, folks,
Awesome.
I want to say thank you so much, Mike, Andrew. And as I like to say here in Hawaii, aloha and God bless everybody.
Thank you, guys. Really enjoyed it. Take care.
Okay, hang on.